Whether you like it or not, there's no denying that since the company went public in 2010, Tesla's stock has soared by more than 20,000%, easily outpacing the market as a whole, surpassing Wall Street's projections, and turning early investors into millionaires. Today, Tesla is the most valuable car manufacturer in the world, surpassing industry titans like Ford and Toyota. In today's video, we'll talk about how multi-billionaire business ARK Investment predicts that Tesla will reach $22,000 per share. What does this mean for Tesla shares? What impact does this have on clients and possible investors? Let's investigate the reasons why experts and investors should think that Tesla's production capacity will increase significantly in the next 5 years. When new manufacturing sites open in Berlin, Germany, and Austin, Texas, many people believe that the demand for Tesla vehicles will continue to rise, particularly in China, where the electric vehicle manufacturer has already done remarkably well. Tesla also benefits from the overall excitement around electric vehicle stocks, as tighter emissions restrictions throughout the world present a clear image of a future auto sector dominated by zero and low-emission vehicles. It has consolidated its position as the dominating force in an EV market and is expected to develop significantly shortly. Today, we focus on the ARK Invest team and the new price targets that they put out. ARK's investment team put up a post based on their research recently on what they felt Tesla's stock could rise to. At the time, they predicted that the company's shares could be sold at $4,000 per share in the next 5 years. So before we go deep into detail, let's have a look at what the ARK Invest target means. Wall Street analysts usually forecast a stock's price markets for a period of 12 months. But in the case of Tesla, several of them have been proven to be wrong for the past few years. Most analysts have even struggled to forecast for a given Tesla quarter. To their defense, a forecast for most companies, even 3 months from now, would be difficult, especially in light of the most recent events and the COVID-19 pandemic. For Tesla, this makes it much harder to predict because a lot can happen in a 3-month quarter. So imagine trying to forecast for a year that's 4 months. Ford's ARK Invest concentrates its research on innovative companies and uses a 5-year period, which is pretty cool as it gives you an idea of how investment companies forecast years ahead of time, as it is difficult for investors to wrap their heads around these gigantic estimates of 5 years. The only advantage is that you don't have to worry about some small fluctuations that could affect a quarter's prediction. So 12 months can be a fairly reasonable time for estimates, and you can get feedback on their predictions to come at the end of the year. The bullish 5-year prognosis for ARK Invest is an astounding $15,000 per share, while the bearish 5-year forecast is $1,500 per share. Their predicted value of $7,000 per share is merely a weighted average and not a price goal. ARK Invest gives each of its price objectives a percentage likelihood, and based on this, has calculated an expected value of $5,000, which it has displayed in a chart. These are the most crucial factors to take into account for Tesla to achieve massive growth potential, and that is what they use to determine their price targets. As you can see, there are some purple dots. These purple dots indicate their expected targets for certain scenarios, and we will get into all of that, so buckle up and get ready. The expected value of $7,000 is not a possible outcome if ARK Invest price targets are correct. The first is their gross margins, which have been rising quickly for Tesla and are currently at roughly 21% in their automotive sector. This is in spite of the greater cost of the Model Y and the lower cost of the Shanghai production. The production cost of the Model Y was equal to that of the Model 3. We are pleased about Tesla's gross margins because of these two important elements, which have also contributed significantly to the company's quick expansion in gross margins. The integration of the Model Y and the Shanghai factory, along with the fact that China will be Tesla's primary export hub, make it even more remarkable. These factors are anticipated to increase Tesla's margins to at least the mid-20s. The short-term goal of 25 is a low estimate for the growth margin input of ARK, as the company anticipates a 40 high. Increased manufacture of Tesla's car models and batteries might result in exponential cost savings as production ramps up. This is another factor that could boost the company's profit margins. The other is capital efficiency, which is comparable to gross margins. If building a factory costs Tesla $1 billion, that amount is recorded on a balance sheet and is gradually depreciated. According to ARK Invest table, which shows a $16,000 per unit vehicle that shows up as an expense over time and reduces Tesla's gross margins on the high end, they predict $11,000 per unit. ARK Invest says the high end is equivalent to the capacity of the Shanghai Gigafactory in China over time. We believe the factories would be cheaper to operate. Depreciation expenses would occur every quarter and deduct a certain amount from Tesla's profits. Develop as their knowledge and skill in creating them advance with each one. Autonomous capability is the third input in ARK's paradigm. According to ARK, Tesla has a 70% likelihood of failing to develop a completely autonomous car and a 30% chance of doing so over the next 30 years. They predict that Tesla will start off charging 2.50 cents per mile before raising it to $1 per mile. Musk stated that Tesla cars would be fully autonomous by 2020, but it's already 2022, and while the company has made significant advancements in its self-driving technology, it's still not fully autonomous. It's unclear when Tesla will achieve this, but it has no bearing on ARK Invest's high-end projections. Because Tesla currently has the most advanced self-driving technology, more information about it than anyone else, and daily orders. They are undoubtedly on track to arrive first. The question is, though, how will Tesla manage to reach the $22,000 per share threshold? The main inputs used by ARK Invest are gross margins, autonomous capabilities, and capital efficiency have all been covered. The price objectives for each are determined by combining the probabilities of each aspect. If you were to look at the table provided by ARK Invest, you would see that the $7,000 price tag is not even included on the list. Instead, it is the result of adding up all of the price objectives. For the case when Tesla files for bankruptcy with a 1% chance, ARK Invest has some really creative titles for each scenario along with their price objectives. ARK Invest calls it the Black Swan. Another intriguing situation is the conflict bus over here. Although Tesla is unable to produce factories effectively, establish its autonomous network, or cut expenses, it is nevertheless able to attain a price target of $1,000 after 5 years, thanks in part to Wright's Law. Based on ARK's interpretation of Wright's Law, Tesla can reduce costs. But it is unable to establish an autonomous network, construct factories effectively, or meet the $2,500 price objective in the Golden Goose, an outcome that has a 12% chance of happening. In this scenario, Tesla can hit all the right buttons. It can cut costs, build factories more effectively, and launch its autonomous network. ARK Invests, whose company manages approximately $11 billion in assets, has stated that in an effort to be as fair and impartial as possible, arrived at that price target after weighing the odds of 10 possible eventualities, including bankruptcy. The company also believes that, in all but the most unlikely scenario, Tesla would sell $10 billion worth of its stocks to boost production as things are trending towards Tesla hitting the Golden Goose scenario. Based on this probability matrix, ARK Invest also projects that Tesla will issue additional debt in the range of tens of billions of dollars in some circumstances to boost manufacturing. In the bear case, however, we project that Tesla will sell 3.2 million vehicles in 2024, significantly reducing its share of total EV sales from current levels. According to our bull case, Tesla will continue to maintain its around 18% market share, and that a sizable chunk of its fleet will generate substantial profit. Is Tesla able to achieve the Golden Goose situation in terms of robo-taxi platform fees? Please comment below.